there's a lot of people out there that don't know you could self-direct your IRA into different asset classes. And they just figure, oh, my IRA is going to sit with Fidelity forever and or do whatever the S&P 500 is doing, and I'll just listen to them. And that's it. I can't really control my nest egg. But nay, Anne-Marie, nay, you actually can. Is that right?
Yeah, that's exactly right. And that's what we're here today to talk about.
All right, ladies and gentlemen, welcome back to the Passive Cash Flow Podcast. I'm your host, Aaron Fragnito, and we have an interesting guest here today. We're going to talk about building that nest egg, that retirement account. We have Anne-Maria Rogers here with Inspira Financial. How are we doing today, Anne-Marie?
Hey, I'm good, Aaron. Thanks so much for having me on this morning.
Absolutely. I'm glad you could join us here. I really enjoyed talking with you about the retirement funds, the IRA, the 401ks, what we can do with all those different products. And, I want to switch it up a little bit here and kind of move on from the usual conversation we may have with an IRA custodian here on the Passive Cash Flow Podcast. And by the way, to our guests and our listeners, our viewers out there on YouTube, if you're enjoying this content, make sure to hit the like button, hit the subscribe button, and share this with a friend or a colleague who you think would get value. There's a lot of people out there that don't know you could self-direct your IRA into different asset classes. And they just figure, oh, my IRA is going to sit with Fidelity forever and or do whatever the S&P 500 is doing, and I'll just listen to them. And, that's it. I can't really control my nest egg. But nay, Anne-Marie, nay, you actually can. Is that right?
Yeah, that's exactly right. And that's what we're here today to talk about. My favorite topic is self-directed IRAs and kind of how they're different and I think really a good fit for most of the people out there that have a desire to have a little bit more control and not just park it and let it ride the ups and downs of the stock market, but that
Mhm.
really want to be a little bit more intentional about how they're saving and what they're thinking about investing into and have that autonomy over their planning.
hmm and I remember when self-directed IRAs started becoming more popular, maybe like, I don't know, 7 years ago or something, I want to say. And like at that time, it was like 1 to 2% of IRAs were self-directed. It's still very little. I think it's like 4 to 5% of IRA investment capital is self-directed. Do you know what the updated statistic there is?
Yeah, so I've been in the self-directed industry for 12 years now, and
Wow.
I feel like when I very first started, it felt like such a kind of a new thing or a
hmm
secret, and it
hmm
really isn't. I mean, people have had the capacity to invest in these types of accounts since the 70s. It's
Mm.
just that a lot of the big players, when you think of your retirement planning, you think about maybe where you hold your brokerage account or your retirement account, the big players in the space they don't really dabble in the alternative side. They really stay in their lane and they stay in that publicly traded side. And so I think over, to your point, the last 7 to 10 years, I think we've seen really an incredible amount of awareness around self-directed IRAs. And I don't know if that's just because, more people have found out about it and it's really
hmm
taken off, or I don't know if that's even just the fact that we're on a podcast today or there's more accessible information. Like there's webinars that you can watch and social
hmm
media and YouTube and all these different resources for people that I think it's kind of given them a little bit more awareness that, hey, I don't just have to, work really hard and make my money and park it with a financial advisor. I can have more say and I can be more educated on what my options are. And even if I'm not the one that wants to be actually buying real estate myself, that I can still get involved in real estate, maybe in a more passive approach and get great
hmm
returns and kind of have that real diversification piece.
Yeah.
But I mean, I think in terms of like percentage wise, it's probably, I would say maybe 5, 6%
Mm.
of accounts. So it still isn't a huge amount. There's still so many people out there that don't realize that this exists. But I think in the real estate space, self-directed IRAs have become a lot more prevalent and people are at least aware that it's an option.
Yeah, yeah, exactly. What's interesting to me is some people will say, well, I want to avoid risk with my IRA, so I'm going to keep 100% of it in some mutual funds that follow the S&P 500. And
Yeah.
I understand that, like there's a pretty good chance the S&P 500 is going to go up over time. And if you pretty much
Sure.
keep it in there, it pretty much, on average goes up like 8 to 10% a year, maybe 8% on average or so. But you have down years and you have up years, and that makes people panic with their nest egg and their retirement funds. But I was always taught that diversification was the best way to actually protect your investment. And people are starting to get more creative about their investment strategies. And what I've learned as well is I work with investors that are accredited and make an income of $200,000 a year or 300,000 with their spouse, or a net worth of 1 million, not including their primary
Mhm.
residence, right? So accredited investors, kind of like the entry level to high net worth individual. Then I also work with ultra high net worth individuals and family offices, and there is a real difference upon how they invest. I also work with school teachers, and just hardworking Americans that move into our debt fund, which is structured for non-accredited and sophisticated investors. It's a 506B. So I really see the whole spectrum of how people build their wealth and preserve their wealth and their different investment strategies. And what I've seen is the ultra wealthy, the family offices, generally with a net worth of 250 million or more, are heavily in alternatives, and that can be venture capital, real estate, other investment opportunities just outside of the stock market. They do have some equities and in stocks and bonds, but that might be 25% of their portfolio. And then what I see with more individuals that are not yet accredited or working to become accredited and really trying to build up their wealth, but certainly, still trying to build their wealth aggressively. Maybe 80 to 90 or even 100% of their capital is invested in generally mutual funds that ride the S&P 500. And there's nothing wrong with that. That is a good strategy. You should have some money probably in a mutual fund that rides the S&P 500, but 100% of your money just sitting there. I mean, you're going to have down years and up years. You're really not able to going to get ahead of that 8 to 10% a year. A lot of people in alternative investments, oh my God. I mean, our investors, we're targeting 20, 21% IRRs, 2x, 2.3x equity multiples over 5 years. That's almost double what the average return in the S&P 500 is. So that just goes to show, if you build that out over a grand scale, over a 15 or 20-year investment career, you could just do so much better with multiplying and preserving your wealth. So that's what I see. And it's really no secret that the individuals that invest more aggressively in alternatives, wisely vetted alternatives, have more wealth because they're simply building their wealth more aggressively and their money is working harder than the individuals who aren't doing that. So it's an interesting mindset to I want to avoid all risks, so I'm going to keep all my money in one place. It's almost like the old the Bible story where the master leaves coins to one slave, and he puts it in the ground and buries it. Another guy goes out and multiplies it. Another guy goes out and 10 times 10x's it. And he's saying, you are the one who 10x's it and multiplies it is the one who's doing the right thing. Anyway, little tangent there. So what do you see as the main reason that people are starting to actually, besides the information age, people learning about this opportunity, like what's the frustration people have and they come to you and they're like, I just want to self-direct my IRA. I'm ready to do this and learn about it. What's usually their reasoning behind it?
I always find that it's people that are kind of looking for, I think, more control, or maybe they're not happy with the returns that they're getting, or feel like, hey, maybe there's another way to do this, and I want to be more involved. Oftentimes I would say our clients are coming to us and they have already got a retirement account. I mean, we certainly see people that they're setting up their first retirement account and they're making contributions, and like you said, they're working hard. But I would say that for the majority of people that are looking into doing a self-directed IRA, maybe they have that retirement account from a prior job, and so they're motivated. They've left that job for whatever reason. Maybe they've moved on to a new role, they've retired, whatever the case may be, but they now have access to that previous employer retirement account and they've got to do something with it. And so
Mm.
they're at that crossroads where they're deciding, do I want to take that money and do I want to put that into, my current employer 401k, or maybe should I roll that into an IRA? And so for people that are, find themselves in that position, I think as they start exploring, okay, well, what are my options for where I'm going to roll into an IRA? Then that is where I think exploring self-directed IRAs can be a great fit for people,
Mm-hmm.
because then you have that capacity to be able to choose all your own investments.
Mm-hmm.
And of course, you're getting the tax advantages associated with these. As you start investing into these assets and creating returns, then those are funneling back into your retirement account, and they're growing, in a tax deferred, sometimes even could be a tax free manner entirely. So I
Mm-hmm.
think that's the really big push for people, that, whether they already know real estate and that feels familiar to them, and that, they're like, well, why am I not doing this in my retirement account? Or whether it's their very first time and that, they feel like, hey, there's just another way. I think that, for many, many people, self-directed IRAs can be a good fit. I think
Mm-hmm.
the other big thing that you have to consider is that, you mentioned like investing in the S&P 500. Well, I think one of the big things that people need to consider is the fact that, in an investment like that, if retirement is just a few years away for you, and you're really looking to be using that nest egg, and you're looking to retire and start taking those distributions, then perhaps, putting 100% of your money into an alternative asset like a syndication or a real estate based asset or something like that, where there's less liquidity that you can have, then maybe that's a consideration. But I think definitely for people that are pre-retirement, that they're not living off of their IRA funds, that as
Mm-hmm.
long as you've got some time that you can invest and let that money grow in there, that this
Mm-hmm.
can really be a game changer and create that exponential type of growth that I think people are looking for. And while you can absolutely get great returns, and I'm a huge, huge advocate. I mean, my husband and I, of course, we have, self-directed IRAs, but we've also got publicly traded investments as
Sure.
well, because you've got to diversify. But
Mm-hmm.
I think that, and maybe I'm a little biased having done this for a long time, but, I think that really the only way that you're going to see that really, strong, like exponential type of growth is if you're
Mm-hmm.
probably doing something that perhaps there is a little bit more risk associated with it. And so
Mm-hmm.
then you need to be educating yourself and doing your due diligence and making sure that you're doing a good investment that you feel confident in. But that is really where you're going to see that growth that I think people are really looking for in that retirement account.
Mm-hmm. Yeah, absolutely. And yeah, the liquidity comment is spot on too. There is a time and a place where you need liquidity, and that's one of the incredible things about owning equities in the stock market and mutual funds is that you have immediate liquidity.
Yep.
And generally with LP shares in real estate investments, real estate is kind of notoriously non-liquid. There actually is a company I'm in touch with called PREI Shares where you can list your LP shares on their website and sell your position. So it kind
Wow,
of
that's interesting.
almost in a sense becomes a liquid, more easily liquidated investment. You can kind of also may ideally harvest some of that equity growth by selling it. So that is an option. But so that's interesting. Now let's just go over some scenarios here. I work with a lot of
Sure.
private investors, and maybe they've worked at a number of companies, and they kind of have some old 401ks rolling around from past companies, and maybe even a current 401k, and then they have an IRA, say a traditional IRA or maybe a Roth, and they're putting money into that, and so their investments are kind of mixed over some different platforms, the 401k and the IRA and the Roth. So how do you help them kind of consolidate everything? What's the process of doing that?
Sure. So, at Inspira, really what we like to do is to sit down and to have a conversation with people and look at that and talk about what accounts do you have, what are you looking to invest into, and talk a little bit about some strategy in that regard. I think as I mentioned, typically our clients are coming to us and they've got an existing retirement account, but that can come in many, many different forms. That could be a 401k from a job that you've recently departed from, or that could be an existing IRA that, maybe you've been making contributions to or already converted. And that could look like other type of employer plans that we didn't mention as well. If you were a teacher or worked for the government or anything like that, all
Hmm.
of the different jobs out there, there's different types of retirement accounts other than like 401ks, and all of
Hmm.
those really can be moved over. And so I think the first part is really just understanding, what you can and can't do with these accounts, and kind of figuring out, what do you have an appetite for. I mean,
Hmm.
we see people that invest in these accounts and they are buying residential real estate, a house that, that you or I would live in, and they're
Hmm.
turning that into an investment property. And that looks like different strategies, right? They might be, putting tenants in there and then getting that rental income, tax
Hmm.
free essentially back to that IRA. They might
Hmm.
be, fixing it up and selling it. I would say more commonly see people investing in a passive way. I think a lot of people know they want to get involved in real estate and they have a desire for that, but they maybe fall into the category that they don't want to have some oversight and management over a piece of real estate. And so I
Right.
think the majority are probably investing into opportunities that are a little bit more passive, whether they're like lending or doing syndications.
Yeah.
But then we see the kind of the unusual things too, right? I mean, we see, people that are investing into like, crypto. We see people are investing into like private tech companies. It's kind of a pretty diverse variety of investments that you're able to do. But I think we talk about real estate a lot because I think that's probably what the majority of people come to us with a desire to do. I think that, they understand that, or they've heard that you can really, make a good return investing in real estate, and they're just not quite sure how to get started. And so a lot of
Hmm.
times people will look into these passive opportunities with groups like yourself, because it lets them get their foot in the door without actually having to like swing a hammer and
Yeah.
to do anything and manage any, tenants or any of those sorts of things.
Yeah, I mean, there's such a learning curve to being able
Hmm.
to really reposition apartment buildings successfully, and just sourcing the deals is extremely difficult. We'll underwrite
Yep.
100 deals to find one. Everything we buy is off market. None of it's sitting on the market. So there's no way to even get access to the deals we buy. If you're not in the game as we've been here for 11 years in North Jersey. So, yeah, no, that's a good analysis there. And then so let's just kind of talk about the process really quick, and the fees. If you can get a quick summary of someone that is looking to, okay, they have their $100,000 IRA, let's say traditional IRA sitting in Fidelity, and it's going up and down the S&P 500, saying, I want to take 50,000 of that, and I want to invest in this property in Hackensack, New Jersey, with People's Capital Group that we're buying next to the number one hospital in New Jersey. And I see the opportunity there. I like how they've been around 11 years, in-house management company. I'm going to, invest $50,000 as a limited partner in this deal with Seth and Aaron and People's Capital Group. And but I have 100,000 in Fidelity. I'm going to take 50,000 out and self-directing into this deal. How would someone go about doing that?
Sure. So, I mean, really the first step is to decide, what account you're going to be using. And then from there, we can help you to walk through what the process looks like. High level though, people would set their account up, and then when they're ready, they can transfer funds over like from an existing account. And then from there, once they have that investment in mind that they're ready to move forward with, they're going to submit some investment paperwork to us, which really they can upload, all online and super easy in that regard. And then from there, we would fund it. So essentially, the IRA purchases, this investment, and then as there are returns, it would come right back into the account. And I would say for the average client, that looks like about 350 to 450, I'd say, on average annually. So it certainly isn't a high cost. Inspira Financial, where I work, does not take a commission or a cut of your investment. So it really is just a flat custodial type of fee. But typically for clients, it's $100 like for the setup, and then it's 350 annually to be able to maintain that. And that's
Hmm.
really it. And I think one of the other things, to your earlier point is I think people have to think about diversification. And one of the great things about Inspira that's really unique in the self-directed space is that they also have publicly traded investments as an option too. And so that's a really unique differentiator because there's not many players in the space that have the capacity to be highly experienced in alternative assets like real estate or like these other alternatives. And also that, when you have dividends coming back from your investment, sometimes when it's not a very sizable amount, you're kind of left and it's like,
Hmm.
well, what do I do with that $500 that came in this month or that $1,000 that came
Yeah.
in this month in returns?
Hmm.
What do I do with that? That's not enough to reinvest it. And so one of the
Hmm.
great things about Inspira is that there are investments, mutual funds, CDs, stocks, different things that you can be doing. And so when you have those returns, you could redeploy those until you accumulate enough to then do another alternative deal. So I think that's a huge thing that I always like to mention to people too, because I think we really allow you to take advantage of that compounding effect
Hmm.
because you can immediately reinvest those returns.
Right, right. That's interesting. So Inspira has like different mutual funds that you suggest, or you actually like have developed these funds that people can roll those proceeds into? Because that is an issue I come across. Our properties produce cash flow of like
Right.
maybe 2 to 5, 6% a year. So if you have $100,000 in a deal, maybe you're getting $5,000 a year or so in cash flow. And then there's big liquidity events upon the refinance and the sale. And that's where the
Yep.
real profit is earned. But those can be 3, 4, 5 years down the road. So,
Sure.
in the meanwhile, as you're getting that cash flow, instead of having to just sit in your account, you're saying that Aspire offers mutual funds you can kind of roll that into for the time being.
Yeah, that's exactly right. So
Mhm.
we really have the capacity where people can be trading and doing the publicly traded side as well. So, great for people that, perhaps they want to hold, their account in just one location and they have a capacity to diversify or for
Mhm.
people that just have their self-directed account with us, they also have the ability to immediately redeploy. And
Mhm.
in fact, Inspire actually does quite a number of things. So self-directed IRAs is what we talked about today and really what, I'm passionate about and specialize in. But we also do a number of different things. So we're really kind of a holistic solution in the sense that we do health, benefits, retirement, and wealth. So
Mhm.
one of the other things that may be of note for some of your listeners is that we also do 1031 exchanges as well. And
Oh,
so, I think one of the great things about the company is that there is really this breadth of services. And so it's not just a one-stop shop, hey, I've got my brokerage account at this place and I got my self-directed at this place and I've got, this other account over here. And it's really kind of that multifaceted solution for people. So there's a
right.
lot of different things that, people can be doing with us.
That's interesting. I didn't know you are a 1031 intermediary. We have a lot of clients that come to us that own property and are looking to sell. They're tired of being a landlord. They're ready to get into a more passive position. And we do accept 1031 capital, and we can help them become more of a passive investor with a 1031 exchange in one of our opportunities. So that's interesting. But now that's of course outside the IRA, right? But you could always maybe
Yes.
do a 1031 and put a little money into your IRA or something like that, but that's more of a different wealth strategy. Um, okay, that's good to know. And so you do wealth management, you have insurance options there as well. So you're kind of a one-stop shop for people's financial needs in a sense.
Yeah, exactly. Exactly. It's pretty diverse in terms of what we can do for people.
Mm-hmm. How long has Inspira been around for?
Gosh, Inspire's been around for more than 20 years. I've been with the company for about a year now. Inspira recently acquired a couple of self-directed companies in the space. So they acquired Quest Trust Company and Newview
Mm-hmm.
Trust Company as well. So in terms of size, Inspira has about 8 million account holders across all their lines of business. For
Wow.
self-directed specifically, about 100,000. So,
Mm-hmm.
definitely in terms of length of time and that stability and security that you want in your financial company, Inspira definitely brings that to the table.
At People's Capital Group, we help you invest in real estate.
Build your wealth by owning professionally managed apartment buildings in the northern New Jersey market. We want to show you how owning real estate is attainable even for the busy professionals that don't have the time or experience investing in real estate. Now, we only work with select people who are serious about building wealth, so find out if you qualify at peoplescapitalgroup.com. Yeah, that's a very important thing, especially when it comes to someone's retirement money, right? You want it to be protected and safe and well taken care of. So that's great. That's great. I didn't realize Inspira was so large and has been around for so long. That's interesting. And that's a good so I think I heard a Quest. Yes, that's interesting. They acquired that. There's a lot of it's become a more and more popular business model. These self-directed IRA, there's a lot of them out there. So you got to differentiate amongst all of them. And then, so let's briefly talk about here before we wrap up, just kind of some of the things you can and can't do with a self-directed IRA. I have people get in touch with me a lot. They're like, I love the self-directed IRA thing. I'm going to buy a beach house. I'm going to go there with my family every summer. We're going to stay for free. And, and then I could rent it out when I'm not there in the colder months. And I'm like, well, my friend, I don't know if you can do that. I think you might want to
Yeah.
talk to your IRA custodian about it. Other people be like, this is great. I'm going to just I could start a self-directed IRA account and pay myself for my IRA. I was like, no, you can't get around the old tax man there. It's still an IRA. But so what can and can you not do with a self-directed IRA?
Yeah, you gave two great examples, but there's definitely a few things that, are parameters that you want to be mindful of before you
Mm-hmm.
start investing. Um, I think the biggest thing for people to be aware of and kind of an easy way to think about it is, think about who's in your like inner circle, your family tree. Typically, and doing specific things alongside those people is going to be a no-no. So,
Mm-hmm.
that's going to include like your spouse, parents, children, their spouses, and the companies that they're involved in. Those are typically kind of outside the bounds of what you're going to be able to do with them. And so you
Mm-hmm.
gave some great examples. So, if you had your IRA buy a beach property and it was an investment property for all of the weeks out of the year except for one of them where you wanted to go down with the family and you were going to stay in the property that your IRA owned, that would be something that would be a no-no in the account because you're
Mm-hmm.
getting some type of like personal benefit, you and your family, for staying there. So really,
Yeah.
I think the important thing for people to think about is that whenever you're doing these investments, it's got to be for the benefit of the IRA, not for the benefit of you or for your family. And so, when you're doing the investment, I think, and you think about it through that lens, it kind of makes it a little easier to think through. So, an obvious one, staying in the property. If people are fixing up a property, you can't drag your family down there on the weekend and be like, all right, we're going to go and like fix up the property ourselves now. Something like that is, again, not, permitted, but, you can invest into any private company. You can invest into any type of like syndication or buy any real estate as long as it's not like something that you already owned or your family already owned or your family's business that you guys own 100%. Those are not going to be things that you can do, but any other type of investment opportunity in that space is fair game. So that's, I think, the biggest thing that people get tripped up on, is really just kind of keeping that arm's length away from themselves and their family and the transaction that you're doing in the IRA.
Mm-hmm. Mm-hmm. Yeah, that's good. Yeah, there's more stuff you can do than you can't do. And that's kind of the purpose of the IRA custodian, is to guide you in what you can and can't do. Now, does Inspira allow the self-managed LLC, where you create an LLC that's owned by your IRA but managed by you? The checkbook IRA account, as it's called, is that something Inspira allow? I know a lot of IRA custodians kind of encourage against that because there's a lot more risk to it. Essentially, you're taking the responsibility of making sure you don't break the rules, and people tend to break the rules by mistake often. Does Inspire allow that, or is it something that your group frowns upon?
We do offer that,
Mhm.
though I think for the first time investor that's looking into this, I don't know if it's always a fit or even necessary. typically, if people are investing, passively into an investment, it's probably just not something that they need to add that extra layer and to set up an LLC and to be self-managing it, though you certainly can. And we do offer that. And, you certainly have the capacity to choose that. I think
Hmm.
that for the majority of people, it's probably just not really a need for them.
Yeah.
But we do offer it. Someone that I previously had worked with used to use an expression and say that, these checkbook IRAs, they're not like a prohibited transaction washing machine. And
Hmm.
so,
Right.
they say that meaning
Uh-huh.
that just because you add this extra layer and that you set up this LLC in there, it doesn't mean that those prohibited transaction rules go away.
Right.
So I mentioned like you cannot invest with your family members, and you can't personally benefit or like extend a service to your IRA.
Yeah.
Those rules don't go away just because you put an LLC in place. And so I
Yeah.
think that for people that understand them, maybe they've got
Hmm.
a couple of these investments under their belt, or they are, very educated on the topic and have really taken the time to understand what are the do's and don'ts, then I think that exploring a checkbook account, I think is a great option. It might give you that more flexibility where you are really like, they call it checkbook control because you're the one that's like writing the check and you're
Right.
in
Right.
charge of the bank account associated with the LLC. So I think
Mhm.
it's a great thing. I just think that it's maybe not necessary for the majority of people out there,
Right.
but that because it's a hot button issue and some offer it and some don't, it
Mhm.
tends to get like a little controversy, I suppose, in our industry. But I think
Right.
it's good for
Right.
some people, but for the majority.
That's a good point you make there. That I remember a story I had from an investor who had a checkbook IRA account. And he's like, "Yeah, this is great. I was just at Home Depot and I got a credit card, for my self-directed IRA account." And I was like, "Buddy, I don't think you're supposed to get recourse debt for your IRA. You might want to check with your IRA custodian." And so that's the thing, you're not supposed to get recourse debt, of course, for your IRA LLC. So the whole idea of the checkbook IRA account is you can get access to the money faster. You don't have to go to the IRA custodian and say, "Hey, I need $100 check to pay my landscaper." And they'll say, "Okay, there's a 3 business day processing and like a $10 fee or something." So like the idea is, you get the money faster, but there are risks to it for sure. And I think probably more people than not tend to break the rules a little bit, and like that example, getting a credit card for the LLC, you can't do that, or you can't self deal or whatnot. So, or pay
Right.
yourself a management fee, really. So, um, yeah, so that's one of the challenges there. But all right, very good, Emery. No, it's been nice chatting with you here about IRAs, and
Right.
we've really dug in here and into the nitty gritty. So how can people learn more about Inspire Financial and get in touch with you?
The best way to get in touch with me directly or to the team that I support here would be to send an email. You can email me directly. Happy to answer any questions. But my email is Anne-Marie period Rogers at inspirafinancial.com. Otherwise, people can visit the website at inspirafinancial.com and select self-directed IRAs. There's lots of opportunities that you can see for education. We've got, articles and white papers, and we actually do webinars a couple times a month where we educate people on different investment opportunities and strategies and trends and different topics about IRAs too. So we'd love for people to tune in and listen to that and just get an understanding of how you can really take advantage of this and have, like I said at the very beginning, really that control and that autonomy over what you're doing with your future and your retirement.
Absolutely. And I might pop up on one of those webinars later this year,
I
right?
think so.
Keep an eye out for People's Capital Group there on the Inspira education section. So we'll team
Yes,
up on
that'll be
that.
great.
Yeah, looking forward to that. Thank you. Thank you so much, Anne-Marie. And by the way, our listeners who are listeners, not viewers, it's Anne with an E, Anne, Marie Rogers. So what was that email one more time, Anne-Marie?
It's Anne Marie period Rogers at inspirafinancial.com.
Okay,
And
great,
that'll
great.
come right to me.
Yeah, absolutely. And your website does have a lot of information. So check out inspirafinancial.com, and there's a lot of content on there you can enjoy for free, and they can get you set up with your IRA, or just answer any questions you might have about it, or all the other services I didn't know you offer. That 1031, that's pretty cool. Yeah. So listen, if you're doing a 1031, get in touch with Anne-Marie, get in touch with me. Let's make it happen. She could be the intermediary here, and we can move it into some passive investments. So to our listeners and our viewers out there, thank you so much for engaging with the Passive Cash Flow podcast. We come out with a new episode every 2 weeks, and we have all different types of guests. As you can see here, people practiced in their arts of all different types of financial services, tax advice, investment professionals as well. And we focus on real estate primarily, but other asset classes as well. I've had RIAs in here talk about income investing. And so always a new guest every 2 weeks here on the Passive Cash Flow podcast. I think we're up over 190 episodes or so, doing this since 2019. Boy, if I knew then what I knew now. So just working hard here to bring some quality content to our listeners and our viewers. So hit that like button, hit that subscribe button if you're enjoying our content, and share it with a colleague or friend or family member who you think would gain value from this episode of the Passive Cash Flow podcast. Thanks a lot for listening. Have a good day.